Hi, everybody. Thank you for joining the webinar. I am joined by an amazing group of professionals today. Our host is Patrick Dawson from Patrick Dawson Law, obviously, and he will introduce our other panelists. But I just wanted to dive in and give Patrick a shout out. Many of you, I'm sure, know him as a local lawyer with 10 years experience in the industry. And look, one thing I really resonates with Patrick is he really cares about his community and he cares about people, and also assisting people and families in achieving their goals in life, whether that be through property law, family law, and a range of other areas of commercial law that he practices in. And the objective of today is to really give people an education, some insight, some guidance, and practical advice on what the current situation is with inflation, interest rates, and everything that's happening in our political landscape and the economy, just to put a little bit more perspective and confidence in that. So Patrick, I'll hand that over to you to introduce our other panelists. Throughout this, just to let people know, apart from my phone dinging nonstop, even though I've turned everything off. Thank you, Mac. We will be encouraging people to type in some questions. So if you do have a question, type it in there. I'll be moderating and I'll give you the opportunity at various points to jump on. You can either turn your video on or microphone and ask the panelists directly yourself, or I can ask the question for you. So over to you, Patrick.
Thank you, Letitia, and thanks for assisting today as a moderator. It's greatly appreciated. And it's certainly an exciting and interesting topic that we're here to discuss today. So without wasting any further time, I'll introduce some of the guest speakers that we have today. So first of all, I have Andrew Pellow from QPL Real Estate. So Andrew is a local to the Riverina area. He's been a sales agent for the past 7 years. Andrew in particular works in offices in Leeton, Narrandera and Coolamon. He's passionate about the housing industry and with a keen interest in investing and the general housing market across the region. He gets a lot of enjoyment out of the property industry by helping first home buyers get into the market and assisting people create wealth through property. So welcome, Andrew, and thank you for coming along today.
Yeah, thanks, Patrick. Thanks for having me on, mate. It's good to be here.
Yeah, no worries. Our next panelist is Rob Fry from Adams Keneally White, Chartered Accountants. So for those who don't know, Rob comes over to Narrandera 1 day a week, every Wednesday, but Adams Keneally White have several offices in regional New South Wales. Rob loves working with his clients to help them make smart financial decisions. You'll have to forgive Rob today if he appears a little dishevelled. He and his wife Ella have just had their first child, Isabella, 4 months ago, and he's still adapting to the reduced sleep. So, but good to see you here, Rob. So thanks for coming along.
Beauty. Thanks, Patrick. Looking forward to it.
And lastly, we have Janelle Broadhead. So Janelle is the local branch manager here at the Bendigo Bank in Narrandera. She has over 30 years experience in the banking and lending industry. Like Andrew, her favourite part of her role is helping first home buyers see their dream of home ownership come true. Born and raised in Wollongong, she's now lived in the area for over 8 years, and in her spare time, she enjoys spending time with her 2 children and 3 grandchildren. Welcome today, Janelle.
Thank you.
So the purpose of today, as we said, was to address some of these concerns and interests around the new interest rates. And so how we're going to structure it is just, I've got a series of questions here for each of our panelists, and they're going to shed some light on the topic. So I might kick it off with Andrew. So Andrew, do you think the sudden increase in interest rates will see a shift in the market?
Yeah, look, Patrick, it's a hard one to answer that one. Regionally, probably the small impact of the minor increases we're seeing at the moment don't really, when you look at the numbers, don't really affect the market a lot. Like your payments are so minimally changed that these small increases obviously make minimal effect. I suppose we're saying interest rates were too cheap as they were. People knew that they were going to go up at some point. So it's just happening now. What we're seeing probably in the market, mate, is a bit of a levelling. You know, obviously the market's jumped substantially regionally for the last 12, 18 months. But it was too cheap before that, I reckon. So it's probably just we're seeing a bit of a levelling now. I expect prices will level and then go back to what they used to do, where they'd increase on a gradual scale over a number of years.
Exactly.
No, that's really interesting, Andrew, and certainly a very good observation. What are your thoughts, Rob? Do you think the media is dramatising the increase in the interest rates, or what are your thoughts?
I don't know about dramatising, Patrick. I guess that maybe depends on where you get your news from, but there's certainly a lot more coverage of it. And I mean, you look at the beginning of May, you talk to people and everyone would know that the Reserve Bank are having their monthly meeting to make a decision on interest rates. So there was certainly a lot more coverage there. I think that's probably a good thing, mate. I think with more coverage, people are more informed and more engaged with that aspect of the economy, and it can help people make smart financial decisions, I guess. So definitely more coverage, I'd say.
Okay, thanks for that, Rob.
Yeah.
And Janelle, so you're on the forefront here with the banks and everything, working with the bank and everything else like that. I think a lot of questions have been asked around the lending process and the application. So I think before we get into too much about current interest rates, how is the interest rate factored into when applying for a loan with Bendigo, for example?
So when we do our calculations for their affordability, in the background, we built in an extra 2%, which allows for future increases in the interest rate. So as when they do go up, it doesn't impact the customer too dramatically. I will agree with Andrew, interest rates have been too low for too long. And so we will see a slight change in it, but hopefully with that built in, it shouldn't affect people too much to start with. If they continue to go up, I think we will see quite a few people putting their houses back on the market. But I think they've been too low, and I think they're going to level out, and we'll see that it shouldn't change us that much because we've had it built in the background there.
Okay, that's a good point there, Janelle. So is that practice across most lending institutions, or?
Yeah. So after our last banking increase, there was where we had to be seen to be responsible lenders. So we had to everyone has to build it in, so as that as the increases come, it's not too much of a dramatic for the customers. But I know that Bendigo has always had that in our calculations, and I will say we dig deep now into their living expenses and to all of their expenses, not just what their income is. So we, as a financial institution, we are now taking a deeper look into what commitments customers have before we look at what they can actually borrow.
That's interesting. So like a safe lending, basically.
That's exactly, yeah. So responsible lending for the customer.
Okay. Well, I think there's a general consensus here amongst the three of you today that the interest rates rise has been a long time coming. So Andrew, what do you see the predictions there with the future of the property market? I mean, even if there is some sort of plateau of interest rates in the future, what do you foresee? Do you see a stable market or a drop in prices, or is it too early to tell?
It's probably a little too early to tell, Patrick, but my prediction is we're going to stabilise. As I said before, the market regionally has been too cheap for too long. And I just think that it'll go back to what it used to do, where it used to go of an increase of anywhere between sort of 3 and 6% a year as a gradual climb. If you looked at it over a 5 or 10 year period, that's what you'd see. And I think now people have realised, right, well, that's where the market is regionally now, and it'll just, plateau for a little while and then gradually increase to what it used to do. It's interesting as to what interest rates do to it, depending on how high they go. Obviously, is going to be the effect. But even regionally, like you've still got you know, in our areas we cover, you've still got medium house prices sitting anywhere between sort of 250 and 350,000. So if you're already in the market, you're probably nearly paying less than what you would be in the rental market anyway. So you're pretty well, once you're in the market, you're pretty set. And, you know, these interest rate rises aren't going to be, you know, huge amounts that are going to be hurting a lot of people regionally, I don't think, anyway.
Okay, that's an interesting point. Rob, I can see you've got your hand up there. Did you have something to add?
So just a question for Andy on that. So talking about the market regionally, do you see people making a change from living into the city to moving to the country and that impacting the market at all?
Yeah, there was a big influx during COVID, which I think had an effect on the market. We're still seeing that off the add-on effects of COVID, I suppose. And people are just after that lifestyle and being able to work from home and all those sort of things. Now there's so many jobs promoted that you can work out of anywhere in Australia, so or in the world for that matter. So we're still seeing people move out to that effect, and that may be a reason why the regional market sort of stays level and doesn't drop back like some of the sort of metro markets that we're seeing at the moment.
Thanks.
Thanks for that question, Rob. But now I've got a question for you. And this is sort of more focused around inflation. So naturally, where there's an increase in interest, you can see an increase in inflation. What are your predictions around that with the new financial year coming up?
That's a tough one, Patrick. I think my question to Andy was a bit easier than that one. Where do I see inflation going? It's hard because there's so many factors that impact on inflation, and I guess a lot of those are outside of the control of policymakers and decision makers in Australia. So you look at something like the war in Ukraine at the moment, which impacts the supply of oil and wheat, fertilizer, and the list goes on. And then that drives the prices up of you know, pretty much everything in Australia, and increases the cost of producing goods and services. So you look at that. You also look at other Western countries like the US, who has, I think, their inflation something like 7 to 8%, or maybe 8 to 9 even, and the UK is about 7%. All of those factors indicate to me that inflation will remain fairly high. I think if you can sort some of those supply issues out, then maybe it might come back a little bit. And obviously the RBA are also, Reserve Bank are also trying to help with that by increasing interest rates. But I think it's a lot of different factors. So if you can sort those supply things out, then it'll go a long way to normalising it.
So just based on what you said there, would it be fair to say that an increase in interest rates doesn't automatically affect inflation? Like there is, as you identified, a number of factors. And do you think that a lot of people would be, I guess, naive to think that the two are always going to be codependent on each other?
Well, the economic theory is that the two are interlinked. So an increase in interest rates will reduce inflation because people will be spending their money on their mortgages and won't be spending money on goods and services, which reduces the demand, and before everyone's eyes glaze over with supply and demand talk. So that's the idea there. But there are external factors as well, which are not impacted by the Reserve Bank's decisions every month. Does that answer your question?
Yeah, no, I was more so just to sort of flesh it out a little bit more. And but no, thank you for that. That's
sure.
That's really good.
Can I ask a question?
Yes.
So in terms of like the average household, and we'll talk about the Riverina, given that that's our audience, you know, what should people be doing to plan for these rising costs on a really practical level? Because if people are injecting more into their mortgage and they have to, and I know we were warned about this, but that doesn't mean people were planning. What could we be doing on a really practical level to actually prepare for this inflation? And what does that look like, say, on a weekly basis for the average household?
Sure. So if I can maybe answer that for households and small business, because it applies, I guess, similarly to the two, but I've got a bit more experience with small business. So what we look to do is it's quite important to run budgets and look at what you've been spending your money on in the past 12 months and where you expect it to go in the next 12 months. And you would, say, apply an inflation figure to those expenses. If some of your expenses are wages, then you would apply a wage growth figure, and you finish up with a total list of expenses. And if you then apply that against your income, you'd have a profit that's left over. And in times of high inflation, if you didn't change your revenue, then you would essentially be working the same amount for less money, which is not the direction anyone really wants to be going in. So then small businesses would need to look at their pricing so that they can look at keeping up with those increases in inflation and interest rates. I guess households would be the same, Letitia. It's a little bit more difficult to look at your revenue figure if you're on a salary, but maybe looking at adjusting those expenses perhaps. And as Janelle said before, the banks build in a margin there, so hopefully a small increase in interest rates will not have too much of a catastrophic effect on households. So yeah, I hope that answers your question.
Yeah, I think a lot of people are just sort of concerned that, big changes are coming. People have lived through, various crashes, the 80s, and, all those different, I can't remember, was it under the Hawke government where we had that big inflation? I was a little bit too young to remember clearly.
I wasn't. It was, my home loan was 18% when I bought my first house. So
that comes back to the question: are we going to get to 18%? Maybe people.
No, those days are gone.
I think they learned a lot from that.
Janelle, you're seeing a few people do a bit of a fixed and variable structure at the moment. Like, you're seeing a bit of a push on that.
We've had the inquiries, but they're not at the moment because our fixed rates are so much, like the banks and the four big ones and ourselves included have already moved our fixed rate. So at the moment they're sitting around the 4-5%, whereas your variable's still down there. So people aren't willing to jump yet. They're sort of waiting to see what happens.
Yep.
So my prediction is because in June there will be another rise more than likely, then you'll see an influx of people wanting to come in and do the fix. But my conversation is it's not always best to fix your loan in. You need to look at each person individually and see what's their next 12 months looking like. If we're going to be doing changes, what are we going to do? Do we really want to fix it in? And then there's always the option to split it and do half variable, half fixed, so that you've got the flexibility. So it's a case of speaking to that person and knowing the sort of customer and what their needs are. But yes, there has been a few people ringing in, and when they find out where the fix is sitting at the moment, they're all staying put.
Yeah.
I think that's really good advice, Janelle. It's definitely on a case-by-case basis, and it depends on people's appetite for risk and what their budgets can afford if there are increases. So yeah, I think that's really good advice.
Yeah.
And just on that note, Janelle, as we've all sort of identified, interest rates have been so low for a while. What about at Bendigo? Are the rates still fairly competitive?
Yeah, so I did a bit of a check around the big banks, and we are still very competitive compared to them. I guess one of the major difference with Bendigo as well is our variables actually go on a scale. So the loan value ratio, the lower the risk to us, obviously the lower the interest rate. So there's a lot of scope to tailor it to that customer, where most of the banks, you have a variable rate, and that's what your variable is. Ours is on a scale. So if you have more equity in your property, obviously you're going to get a better interest rate. But comparing all the big banks, yeah, we're definitely very competitive.
Just for those who don't know, Janelle, would you mind just sort of fleshing out what your loan to value ratio sort of means and how it affects your lending?
Yeah, so when we look at a loan, we look at it in two ways. We look at the loan value ratio, which means that we take the value of the property and then we divide it by the size of the loan. So a maximum loan that we would do would be a 90% lend. So that's 90% of the value of the property, not including any solicitor's cost or anything, just the value of the property, and we'll lend up to 90% of that. So that's the major part that we look at. So we try and do up to 80% without mortgage insurance. Once we hit 80%, then we have to get mortgage insurance. Now, mortgage insurance is where we go to an external company to cover our risk, because anything over 80% is considered a high risk to the bank. So then we go externally and get someone to cover our risk for that amount. So that figure is then added on to their loan and built into their repayments that way. So that's one side of the loan that we look at. And then the other side we look at is their income and their serviceability to be able to make repayments on that loan. I think that's a big thing that first home buyers don't understand, that it just doesn't go on how much you're earning and what deposit you've got. It's built into how much equity that we can get in that property. What's the size of the loan that we're doing to what you're borrowing? So how much is it going to cost for the property as opposed to how much we need to borrow against it?
So it's basically just assessing sort of the risk as well for the loan.
Yeah. And that's across the board, no matter what bank you go to, they all, anything over 80%, any value over 80%, they will need to get mortgage insurance on it. And we always talk about LVR, which just stands for loan value ratio. So it just takes the value of the property and divide it by the amount that you're going to borrow.
Okay. And do you have any tips for like people wanting to get into the market? Like, you know, we're talking about like the bank assessing the risk of an individual. What can, I guess, a first home buyer, for example, do to improve their chances of being approved for a loan? Like, is it savings, spending? Like,
one of the biggest things that I see, especially with younger ones that are trying to get in the market, instead of having the money in their account, they put the money in mum or dad's account and get mum to hold it for them. The problem with that is when they come to see me, I can't see genuine savings in the savings patterns because it's in mum and dad's name. Best thing is have an account, even if you're only putting $20 a week into that, it's showing us that you have a savings pattern and that you have the ability to put money across. Because if you've just come in and you tell me you've got a deposit, but I've got no way of seeing how you've built that deposit up, it's not genuine savings. The other thing that with our living expenses, if you're going to the same coffee shop every day and you're spending $4 and it's coming up on your account, the same place over and over, looks worse than if you say take out $100 a week for your spending for that week, and then there's only one transaction on your statement. Because if what we do, we go over the last 3 months of your statements and we compare to what you're telling us that you're spending to what's coming out of your account. If we see McDonald's every day, it's like a red light saying, look, they're spending. Whereas if it's one amount coming out, it's not so much in glaring up, if that makes sense. So if you put yourself a budget, and especially like if you're going out on a Friday night, take out the money you're going to spend on the Friday night. Don't go to the local pub and use the ATM every half hour, because all that shows us is continuous spending out of it.
Oh, that's really good advice, Janelle. And following on from that, Andrew, you mentioned as well that you also share a passion with helping first home buyers achieve their dream goals as well. I know there's a lot of contention at the moment with the current election, but I would like to just focus on current opportunities available for first home buyers. Andrew, can you share any light on that, or Janelle or Rob, if you want to chime in as well?
Yeah, look, the no stamp duty exemption for first home buyers is still obviously a big one. It saves your first home buyers so much and allows them to get to the market so much quicker than what most normally would. And look, I guess it's just an assessment on, how quick can you save that money, because especially regional areas, you still, you factor it to what rent you're paying and your figures are fairly similar. You sort of, people ask me all the time, when's the right time to buy? And if they're paying rent, I'm always, right, I get in now. It doesn't matter if the market slips back a bit, at least you're in the market. You're not paying out dead money to something that's not growing in value. So, or should be growing in value, and over years it does. So.
Yeah, okay. Yeah, thanks for that.
No worries.
I will just touch on, so we hear about the government where they cover, you can have a 5% deposit and come in. The big thing that is not widely known is that, say as Bendigo Bank, all of Bendigo Banks get given 10,000 places. So that's for all of us. So what happens is you go on a waiting list, because obviously it fills up very quick. And if you think of someone like one of the big 4 banks, 10,000 there would go, we get it issued once a year. They go very fast. You then go on a waiting list. When you make it to the top of that waiting list, you have 90 days to find and settle on a property. If you don't, you go back to the bottom of the list and you've got to wait again. Now, those loans are governed by the government. Once you're in them, we can't do increases on them. We can't change them around. The only way you can increase one of those loans is pay it out and go into a different product, because what it is the government's guaranteeing, where I discussed the mortgage insurance premium amount, the government then pays that to the bank, and that's where you only need the smaller deposit. So you're still lending the same amount, but the government's covering the bank's risk. So once you're on one of those, you're pretty much in it until you pay it out.
So you couldn't borrow equity out of that loan,
no,
to use for property or anything like that. Geez, that's interesting. Most people don't know that.
and most of the people don't know that. And when you jump on the website to read up about it, it's like 60 odd pages, and it's too overwhelming for most people. They get halfway through it. And to actually qualify for one of them is quite in depth to do. So it's not as simple, like the ads make out like every bank has them, but we only get a very, very small portion, which goes very fast. And then you're on a waiting list. And you know yourself, properties are coming on, but they're going really fast. So I tend to say to my customers, if you can save the bigger deposit, then you've got more flexibility, because no one buys their house and loves it. They always buy it and they want to put a new kitchen or paint or do something to it. And if you're in one of those loans, you can't.
Yep.
You can't.
There you go.
So I guess this is where, first-time homeowners should be reaching out to professionals like the three of you to get that advice and start planning a pathway well in advance before they even make an offer on a property.
Yeah.
No, it's certainly interesting. Now, Janelle, have you come across? I know there is we've spoken about the 5% deposit scheme, and Andrew, you might be able to chime in on this as well. The 2% deposit scheme for single parents, is that still available?
Yeah, I haven't had to do any as yet.
Yep.
Andrew,
Okay.
have you had any come up?
Again, because you get come up to me and say they can do it. Yeah.
No, because again, it's such a small little window of getting on it that, I haven't done any.
Do you mind if I can probably chip in here, because I went through it and I highly recommend it. I've recommended it to a number of my other single parent friends, because for me, I didn't experience that it was difficult to get at all, because I went through a broker who knew exactly which lenders to go to suit my situation, because, as a single mum and a business owner, I've got a few, it's harder for me to get lending. So speaking to him in advance, well before the end of the financial year, just allowed me to position my finances to reflect what he knew particular lenders would be looking for in that application process. So we were able to, he was speaking to my accountant, he was working with me and my bookkeeper to ensure a pathway 3, 4, 5, 6 months in advance, to ensure that when we were planning on lodging that application, we were in a position of strength to enable to act really quickly and get that across the line. And we were targeting specific lenders based on those requirements that he knew I would best fit. So for me, you know, that's where speaking to a variety of experts and planning for it really came and made it so much easier to get over the line, and obviously less stressful for me. But, you know, my experience is it wasn't difficult to get. And I think in the reality is a lot of people just don't know about it still, which is, I don't know how that's possible, but so many single parents on forums that I'm speaking to just aren't aware of this scheme offered still. So that's my little bit of insight.
Awesome.
Thanks, Letitia. Rob, I can see you sitting there a little bit quiet, so
Smoking it in, mate.
No, I just want to you touched on earlier with local businesses and the impacts that interest rates and inflation may have on that, and I was just wondering, are you able to expand on that a little bit?
The impact of inflation on local businesses?
Yeah, and the rise in interest rates.
Sure. Well, I guess like Letitia just touched on there, a lot comes down to planning, I guess regardless of what situation you're in. So if you can...
Now's a good time to start your planning, really, isn't it? Your tax planning for the end of financial year.
We're right in the middle of it.
Yeah, no, that's good.
It's a busy time of year. So, yeah, so it's important to plan what's coming the next 12 months and really make decisions now about that, so you can make decisions about the pricing of your products, just to make sure that you are not going to be left short by the rising cost of inputs,
yeah,
and interest if you're exposed to interest. And I think it's which I touched on earlier with the media coverage of this and people being more engaged and aware of financial decisions that impact them, you know, that can be a good thing. And as long as their business owners are thinking about it and talking to, you know, accountants and financial planners and whatnot, then it's a good thing, and it will set you up for not to be left short, I guess, in an environment of rising prices.
Yeah, no, that's good. As a what I guess that old saying is, you either fail to plan or plan to fail. So I think that's where your these services of an accountant are really important, because it can help, especially local businesses, smaller businesses, right up to the larger businesses, plan and strategize for these unknown events like increasing interest rates and things like that. So taking on board that advice could be really beneficial. And I suppose you could possibly even narrow it down to just the individual, couldn't you, Rob?
What do you mean narrow it down to the individual?
Like even an individual could benefit from, you know, having their chat with their accountant and, you know, planning more effectively with things like taxation and expenditure.
Yeah, certainly, absolutely. And as I say, well, if you're planning for tax, you really need to be making decisions now. So if you want to get some reduce your taxable income by getting more money into super, perhaps that needs to be done now, for example, rather than done in August when you do your tax return, because it will be too late then.
No, that's a good tip, Rob. Yeah. Alrighty, so what we might do now is just open it up to the attendees and the other panelists for any other questions that people might have.
Everybody's been really shy. This is a great opportunity. This is where we get free advice, guys. So don't be afraid to jump in.
I've got one for Janelle. What's is probably a pretty broad question, but waiting times on loan approvals at the moment, how are they factoring in? They're not too bad, or?
No, well, No, your straightforward ones, I can get a turnaround of about two to 3 days. Our more difficult ones, our biggest thing is if I need to get a valuation. At the moment, valuation times are what's blowing me out. So, but yeah, straightforward one, 2 to 3 days, I can get it approved. And pretty much when I look at it, I can tell you if it's going to be like service and all that. It's not till we get deep into it and we sort of do our credit checks and all that we can say if there's going to be anything that pops up on it. But most days when we look at it, we can look and see that, yep, that one will be okay. And then it's just a matter of doing our valuations and all our back checks.
Yep. Well, there you go. Yeah, I remember when it was 2 or 3 weeks.
3 weeks. Yeah. Yeah.
Real estate agents.
Yes. Weren't very happy with us, were they?
No, we weren't. Anyway.
Have you found that the houses coming onto the market are slowing down a bit, where people are sitting tight?
Yeah, look, the supply's still low compared to what it has been over previous years. Yeah, still not a lot of stock on the market and not a lot of stock coming to the market. Yeah. We're seeing at the moment that, stuff that's probably sold, we had properties that would have sold in a week that are maybe taking, 3 weeks to a month now, just with a sort of a slight easing in the market. But it's still such a strong market regionally. It's really good still.
Because like my inquiries wise is still as high as what it is, but I've noticed in the last 2 weeks, it's more inquiries where they want to sit tight for a couple of weeks just to see what's going to happen. I think after Saturday, when they know what's going to happen, we might see it pick up again. Inquiry-wise, I'm still getting a lot of questions, but actually going ahead with it, they seem to be sitting tight. And that's whether or not they're going to put the properties on the market or if they're buying a new one.
Yep.
So what I did find with COVID was that we had a lot more people, because there wasn't a lot of property on the market, doing the extensions to the house.
Yeah,
So
absolutely.
We found that, but I also found, like, going back to if it's going to affect people, with COVID, people weren't out spending as much, so they've paid a little bit more off their mortgages, they've paid their credit cards down. So if interest rates do go up a little bit, I think customers have got that little bit of a buffer with the extra that they've paid over the last 2 years, which has really sort of affected where they used to go out and be doing entertainment things. They haven't been able to do that. So they've had more cash to put into the mortgages.
Yeah, absolutely. And people aren't probably concerned with the price growth of overcapitalising. I've yielded near as many questions about overcapitalising in the last 12 months as what I had previous to that. So people are sort of willing to put a bit of money into their property, and then a lot of people have obviously got equity built up over the last 18 months, 2 years to be able to do that too. So
yeah, definitely, because the prices have gone up. Like the valuations, to see a valuation and then do another one in 12 months' time, the values have definitely been on the increase.
Absolutely.
Alrighty, guys, to maybe just wrap everything up, I might ask each of you or some of our panelists, what are some of the tips they have to survive and thrive in this current market?
I'll go first.
Yeah, sure.
Speak to your bank. Speak to your bank and ask them, because like I keep saying, every person is different. Don't just listen to what's happening to everyone. Look at your situation, where you want to be in 12 months and what you need, and speak to your bank.
Yeah, thanks for that, Janelle. That's good feedback.
Yeah, I'm probably going to pinch Rob's here, but mine's budget for it. I think you just need to be get in front of it and plan out that, it's obvious that interest rates are going to rise. There's probably no getting around that. So it's just budgeting for it and assessing it for the next few years and going, well, where do we sit? What can we afford? And not overstretching yourself to that point.
No, thanks for that, Andrew.
Yeah, I'll pretty much echo that from Andy. Planning is a pretty crucial thing to be doing at the moment. So yeah, speak to your accountant or financial planner and look at where you're going to be in 12 months and go from there.
Thanks, Rob. Alrighty, guys. Well, I think that's a wrap. I'd like to thank each of our panelists, Rob, Janelle, and Andrew, for your time and participation today. To all our attendees, and a special thank you to Letitia for moderating. Just on a final note, any information or representations made by any of the panelists today is not to be taken as professional advice. It is general advice only. But should you wish to obtain more specialised advice, we recommend that you contact them directly after this webinar. Thank you for your participation.
Thanks, Patrick.
Thanks, everyone.
Thank you.